Good morning. We're live. I got myself out of the Power Studio today, and I'm at the Mall of America in Minneapolis. But we're bringing you Columbus CRE today. Hang on while I move everybody's awesome faces out of the way so you can see the title. 6th Annual Columbus CRE Virtual Summit. We're excited to be hosting this live on a webinar, but not live. It's kind of a bummer. I said this yesterday in Cleveland. This is not how I pictured the year going. I would rather be in Ohio right now, helping y'all run a live event, shaking hands, patting people on the back, saying hello. But this is the best we've got, so we'll suck it up and deal with it as we can. I have to thank these sponsors. We wouldn't be able to pivot like this without sponsors. It doesn't come free to be able to do this, use this software. Let me move people around so I can name them all off. We got Berkadia, Duffy and Duffy, Newmark Knight, Frank Trepulus, I hope I'm saying that right, Frost, Brown, Todd, Equity, Capstone, Grand Bridge, Marcus and Millichap, Meridian Design Build, Schottenstein, V3, Sparrowhawk. How you doing, Sparrowhawk? Good to see you again. Corfac, GBQ, Thrive, The Schenck Company, Krug Columbus, Income Property Organization, Peak, and Ohio SIOR. What a great group of sponsors. Thank you. Appreciate it all. Make sure to put this up again as another thank you. We are REJournals. We publish 6 different publications in 17 states. We're going to do about 175 events this year, including webinars and live events. I'm actually in Minneapolis at another live event, which is pretty exciting. We have about 75 people that came to this Minneapolis event live. If you have connection issues, there's a button at the top of your screen that says reconnect, I believe. That's the way to fix it. If somebody's glitching out, if you're looking at your screen and everybody in your screen is glitching, it's you, it's not me. I'm bouncing around signals this morning. Some of our speakers are bouncing around. It could be us, but it's just hit that button, and you can hit it over and over again to get to it. If that doesn't work, make sure Google Chrome is what you're using for your browser. That helps a lot. Or if that doesn't work, copy and paste the link we sent you. That sometimes fixes it. You can also do this on your cell phone, your iPad, your whatever device you want. You can access this event. Okay, chat rooms on the right if you're on your computer, below you if you are on a tablet or phone, and we should be ready to go live. Back to our speakers. So where are we at here? Craig, are you there?
I am. Good morning, Todd.
There you are. I'm going to turn it over to Craig. If y'all need me, I'm going to disappear, but I'll stay here the whole time. Just holler at me if you need me. Thanks, Craig.
Thanks very much, Todd. Appreciate it. Welcome, everybody. As Todd said, this is unprecedented times. Someone told me the other day we're now in month 4 of this, and nobody imagined that we'd be in it this long, and it looks like we're going to be in it a little longer. So very fortunate this morning to have 4 industry professionals with us here in Columbus, and Jason up in Michigan, and Nathan down in Cincinnati to kind of walk us through and give us some insights on specifically where the apartment market is today. So without further ado, let me turn it over and let each of our panelists introduce themselves, give a little bit of color about their organization, and then we'll move on. Jason, you want to kick us off here?
Sure, happy to do so. Thanks, Craig. Appreciate it. Appreciate everybody tuning in on a Friday morning, which seems to be like a long weekend for most people. Ultimately, I'm Jason Krug. I co-lead the Great Lakes team for Berkadia, covering Ohio and Michigan. We finance, we sell, we can help raise equity, multifamily communities, throughout the country. Our team this year, off to a decent start, even with COVID. We closed about $425 million in transactions, mostly in the first quarter. We've got about another $100 million under contract now. Some of that fell apart from COVID. Some of that, is new business. So we're optimistic moving forward, and we think the Columbus marketplace is just the #1 shining light, throughout all of the Midwest, and just for all the reasons I'm sure we'll get to on this panel. We're excited about it.
Very good. Thanks. Jane?
Hi, I'm Jane Arthur Roslovic, and I am the managing partner for Trepulus Communities. We develop, build, and hold 55 plus active multifamily. And we have our first 3 projects here in Columbus and are expanding outside of the Columbus market into the Dayton, Cincinnati market. We are seeing a real need for the rise in aging of baby boomers, and are thrilled to be a part of this real estate forum.
Nathan?
Yeah, Nathan Murphy with Capstone Apartment Partners. As Craig said, I'm based here in Cincinnati, but we do my partners and I do a lot of work up in Columbus, very active market, so I spend a lot of time there. I'm a senior advisor. We're multifamily brokerage. That's our specialty. We do sell land as well, typically designed for multifamily development. We just launched an equity platform as well. But Capstone was founded in 2008. One of the largest privately owned brokerages, and we're probably going to do about $1 billion in sales this year, which is kind of probably shows some positive comments that we'll be making here later, especially showing how well the Columbus market is doing. But excited to talk further.
Perfect. And last but not least, Brian.
I'm Brian Schottenstein, president of Schottenstein Real Estate Group. We specialize in high-end multifamily and mixed-use developments in the Midwest and Florida. Right now, we currently have around 1,200 units in construction, multifamily, and I look forward to hearing your questions and having a good conversation today.
So Brian brings up a good point that I just want to let everybody in the audience know about. There is the opportunity to ask questions. You should see on your screen a chat room. If you would just type in your questions, send them to us. We can't promise we'll get to everyone, but we'll try and get to as many as we can. And feel free to submit those questions now or at any time during the program. So with the introductions out of the way, let's kind of jump right into one of the topics that all of us are dealing with, and the multifamily market is not immune. That's COVID-19. COVID has affected everyone and everything. It's brought changes that none of us would have imagined, and specifically, it has caused owners, operators, developers, investment sales, lenders, everyone to modify or change or do something in their own private sector, or in their own segment, their own sector, to change their business, for lack of a better phrase. Brian, if you wouldn't mind, share a little bit with us about how Schottenstein Real Estate Group has adapted to this new environment to remain, an industry leader.
Well, we never really stopped during COVID. Things have changed, but we continue to build. Construction was considered essential, so we went straight through. Luckily, our residents have been great. We've worked with them, but about 99% of our residents have paid rent on time. So that's great to report. I think people realize how important it is to have a comfortable, safe place to live. So I think the multifamily sector is probably one of the best sectors in real estate to be in right now, because you need a place to live. You don't necessarily need to work in an office or need to go to a store. There's alternatives to shopping online and working from home. So I think the fact that we're in the suburbs too helps a lot too. We've seen a lot of people moving from downtown developments into our developments, both young professionals and empty nesters. So we've really been in a good position, surprisingly, other than obviously this terrible pandemic that's gone on. Our business hasn't changed too much.
Perfect. Thanks. Jane, Trade Plus works in a little bit different space than Brian. First of all, tell us a little bit about what you do. As we talked and we got ready for this program, you reminded me that Trade Plus focuses on what is defined as adult or active adult multifamily. And so first, tell us a little bit about what that means. Help us understand how that's different between seniors and traditional. And then also in the same line or same thought as what Brian did, how has this new normal, for lack of a better phrase, affected what you're doing, changed things that you're accommodating, especially with a segment of the population that you cater to that has been defined as higher risk than most.
Right. We do only do the active adult multifamily, and it is a relatively new asset class since it's so focused on the people who are 55 plus. We are HOPA compliant, which is the Housing for Older People Act, and we we're age restricted, so we only take residents who are 55 and older. And our resident is truly 55 to 98 right now. And so it really is a mindset where it differs, and that's really where it differs mostly from multifamily. We're really a hybrid of multifamily and a little bit of independent living, in that we are geared towards an older demographic. Where we also differ, there aren't very many active adult rental projects in the country that are single story. So all of our residents have private entrances, which, if you're hearing about what's going on in what IL or independent living, a lot of the people are really unable to have family members come to their homes. And so we've seen a big influx of people coming in. We also see, because of the sale of the homes, the real estate housing market is just, as we all know, a residential market. People are buying and selling, and we're seeing a lot of people who want to downsize into our product, which is been a product of the whole pandemic. From an operational standpoint, it has been fantastic how our entire property management staff has pivoted to and raised themselves up to deal with this. So we're doing virtual tours, self-guided tours, Facebook Lives, every way, especially when we were in complete shutdown, we were still getting really good traffic and still leasing, and people were still moving, which was shocking. I won't say that it was the normal traffic did drop off, but I thought our potential customers were even just coming in and really rising to the occasion. We had to shut down our commons, which is the heart of the community, and has the business center and the fitness center, and where all of our residents socialize. And that was unfortunate. And now that we've partially opened it back up, we've had to go into the norm of reservations and wearing masks and not having too many people in. But our community gardens have been a really big bonus for our residents, and we have the most beautiful zucchinis and squash and tomatoes. It's quite terrific. So, and our residents really look out for one another. They're all of the same era, and they all are really enjoying one another and taking care of one another. And we've got all kinds of programs going on for them in their homes. So it's been an interesting time.
Perfect. Thank you. That's a great summation to just talk about a segment of our population that obviously is being very impacted, but it sounds like you and your team have a product that fits, if you will, into a lot of different circumstances. So thanks for sharing that with us. Yeah.
Absolutely.
One of the things that we hear in our business at Grandbridge is that buyers and sellers we're using the word uncoupling, and so that there's a little bit of a disconnect in the sales market. And I wonder, Nathan and Jason, if you wouldn't mind spending some time talking a little bit about how this has affected each one of you, your respective teams, your clients, if what we're hearing about that uncoupling or that inability to get to a close quickly is true, and then just kind of generally give us the temperature of the buyers and sellers specifically. I know both of you work in different markets outside of Columbus, but specifically here in Columbus. I'll let you guys bounce back and forth if that's okay.
Yeah, I'll go first, Jason, but
Sure.
in terms of activity, we really haven't seen an overall slowdown. I mean, some institutional groups are a little more quiet, and they've kind of indicated they will remain quiet for a while. And that's not just Columbus specific, that's just, institutions across the country. But with Columbus, there's so much private equity and family office money here, and they remain very active. I mean, each group is different that I talk to, that maybe some are more conservative than others, but overall, there's so much activity that selling deals and finding buyers, it's not a problem. I mean, it's the only problem still is there's too many buyers. It's not hard to find the buyers, it's finding the sellers. And so that activity is there. I mean, more so when this first started, we were all getting used to it, and there's unknown in the financing and the debt markets. We got to make adjustments and try to get creative on how do we extend deals or make sure we get through everything. But overall, we really, I don't think we've actually had a deal that's died or been closed because of COVID. Maybe the closing was a little longer. And I think that just indicates how strong Columbus is overall, and the private equity that wants to come here. It's a lot of out of town money and foreign investment going to those those private equity funds. But say, things like in New York and government restrictions and rent control on both coasts, that's stuff that just directly benefits Columbus. And that's the private equity money is looking for, that kind of stuff. They understand, even more so now, it might not be the sexiest of markets that, when things are going well, everybody wants the highs of highs, but we're really realizing now the Midwest, Columbus specific, the lows aren't that there, and it's a safer place to come in and get your cash flow. People are still underwriting the 6, 7, 8% year one cash on cash. There's been adjustments on maybe how quick value add goes, rent increases, but overall, people are still finding plenty of deals that meet that criteria, that they can pay out their investment.
Yeah, and I agree with what Nathan said. I think there's, right when this started, a lot of people took a step back. We're waiting to kind of see what happened. The nice thing about, the team that we've assembled is there's a lot of people that have lived through a lot of different cycles. And although this one is very different than anything we've ever experienced, we say that about most of them. So, leaning back on some experience and how you felt during, the S&L crisis or the Great Recession, can help make a team, and it has for ours, kind of more resilient. That's the one thing I'll say about, multifamily real estate, and especially in the Midwest. We've got people that are passionate about what they do, and they very much care about, their residents. They care about, what happens at the site level. They care about their reputation overall, which is what, makes our market in Columbus so attractive. So, you kind of couple, some disruptions in the market for 30 or 60 days. Our conversations turn from, hey, what do you have to sell, to, hey, how annoying are your kids during work from home, or whatever that might have been, right? So it's just kind of that reconnecting. It's a relationship business, and as weeks went by, the institutions were looking for a 10% COVID discount, right? That was just what everybody was saying, out of the gate. But what they realized, and Nathan alluded to this, is that there really hasn't been a discount. Fannie and Freddie have plugged the gap with interest rates for new financing deals. There was a lot of cash sitting on the sidelines. And, as what Brian and Jane have both said, this is an asset class that, is poised to continue to do well, whether that's 55 plus or just conventional multifamily. There's a massive demand for it. And this pandemic only made that more clear. So, there was for sure a gap between buyer seller expectation, but I think sellers have really kind of held, and buyers have come back to, hey, if you want to transact, this is where we're at today. Now, if we weren't staring, 3% interest rates in the face, we may be having a little bit of a different discussion, but, we are. And so I think, again, in the commercial real estate world, and Columbus specifically, you're adding 50 people a day, or, that was the rate last year in 2019, as far as population growth. What other Midwest city outside of maybe where Todd's sitting can talk about that kind of population growth? So, people are willing to take maybe a lower year one return without, pushing the value add, as Nathan was saying, right away, or, just the organic rent growth outpacing, maybe some other markets, but, mostly longer term holders in nature. So, 5, 7, 10, 12, and on from there, everybody believes that, what Columbus has seen and the growth that we've seen will only continue. And so, definitely disruptive, but I think, creative solutions, buyers and sellers coming together on maybe there's an extra extension because of what Fannie and Freddie talked about, or, Krug, you could probably speak to the reserve requirements and what that's done, to the marketplace. But,
Sure.
I think people in our business, we grind things out, right? It's almost a blue collar work ethic in the Midwest. We have to have it, and Columbus embodies that.
Yeah, I agree. We'll come back to and talk a little bit about later the financing aspect that both Nathan and Jason talked about. But we're going to get, and that's part of what I want to do. I want to get a little more granular in our discussion, and I want to start with a topic that's been on the national scene and is here locally. Just last week, all of you may have seen, Bloomberg came out with an article that said 1/3 of American renters expected to miss their August payment. Obviously, this has an impact to everybody involved, whether you're a financier, whether you're an investment salesperson, whether you're an owner, you're an operator. And there's so many different pieces that are involved in it, from employment to stimulus to so on and so forth. Our local economy here, which is a big service economy, is partially shut down. Most of our service providers, or a lot of our service providers, have been forced to furlough or lay off employees. Those employees are predominantly renters. I'd like to get thoughts, if you're willing to share, from Jane and from you, Brian. Jane, probably your group is not affected as much, but Brian, I have to imagine that a large part of your tenant base, or a portion of your tenant base at a minimum, are in the service industry. What are your thoughts on renters being able to pay going forward, and have you experienced any of those challenges to date? If you don't mind, take the topic and run with it.
We're really not seeing any problem at all. I mean, I keep seeing all these articles, and I was on calls with Columbus City Council members, and when the pandemic first hit. But even from the beginning, we've been just really been business as usual. We have a very high profile tenant. Our communities are all pretty new, or built within the last few years. So maybe some other communities are getting affected more, but I haven't been hearing, big vacancy numbers at all. If anything, we're doing better than ever before. So I don't have anything to report as far as like 1/3 of people not paying rent or anything like that. I think that might be in other cities or other types of developments, but we also have many empty nesters who are on passive income as renters. We have, product types that all have their own entrances, and they have, 2 first floor master bedrooms and very suburban open floor plans. So we haven't seen any issues as far as vacancies creeping up or people not paying the rent on time. In the beginning, a little bit, we gave people like a more opportunity to pay it later in the month, and we worked with some people, because we didn't really want to evict anyone if we could help it. But we really didn't have we had like maybe 2 or 3 evictions across the board, so it wasn't more than normal.
Perfect. Jane, is this at all affecting your tenancy?
No, we've had one delinquency, and that was it was very short-lived, and it was because they were a business owner and a service provider, and they were concerned. They were just trying to figure out what their situation was. This was at the very, very beginning, but they are caught up, and it's just not an issue for our resident. Our resident planned for how they're going to live, and that's, no, it's not an issue.
They're insulated, right? Yeah. Absolutely. Nathan and Jason, I wonder as you're dealing with out-of-town buyers, and in-town buyers, is this at all affecting the negotiation, or are people asking for additional, belts and suspenders?
Yeah, sure. I think, one thing that I think, as Brian has said in the conventional multifamily space, not really experiencing anywhere close to the 1/3. I think, to me, that's a headline. We haven't seen it. We get on weekly calls, with our individuals across the country, and I'm very interested in, what's happening in other sectors. And I think, one of the things that we measure quite a bit in the Midwest, and Columbus shows very well, is the wallet share. So, what's my rent to income ratio, and it's much lower, I think, from what we've heard, outside of a Louisiana, in New Orleans or Orlando, right away from, some specific areas that were obvious as to why there may be, deeper pain points. It was, if you're paying 50% of your income's going to rent, so coastal rentals, San Francisco or New York, or areas like that, where the stimulus that was passed with the unemployment getting extended, that wasn't going to cover half of that rent. So that's where we've seen a little bit less percentage collected. But from our clients, what we've typically heard is they're anywhere from 93 up to 97, 98% of rent collection, which is in line with years past. If anything, when they weren't able to file an eviction notice, and again, that's not the goal. Sometimes that's just to get a late payer to pay. But as Brian said too, a lot of our owners, I think, take pride of ownership in the Midwest. They're not looking to evict people day one. They want to work with people. They want to be a resource, right? We're all in this together. We have one common enemy, and that's the virus.
Nathan, anything to add?
Yeah, same thing, and I'm glad everybody said it as well, because when I read these Bloomberg articles or see them, it says 1/3, and I just where, I don't
Right.
get it. I think NMHC posted on August 6th, that's when they their first report, because that's technically, payments are a bit late. It was 80%. That's nationwide. So we're already past that, and that was just on August 6th. And plenty of people are paying a little later, and owners and management companies are working with them as necessary. But overall, from the beginning, April is going to be terrible. May is going to be. It was just like an excuse to kick it down the road, and I haven't seen it. No month have we seen it. I mean, the unemployment benefits definitely help that, and if that does go away, we may be talking a different issue. Maybe those articles are starting to be remotely correct. But I think that stuff's heavily weighed with a Las Vegas or more major markets, because we're just not seeing it here. And again, that's just another reason to be here, to be in Columbus. I think July collections were higher than June. In August, they're expected to be 95 across the board percent collected. And there's differences between A's and B's and C's, and C's collect a little bit less, but still, I mean, it's further proof in multifamily. Would name another business that wishes they were down 5%.
Right.
Right. So I get it, like Jason said, I think they're headlines that are scare tactics. I don't know what it is, but I haven't seen it. I haven't talked to an owner that's seen it.
Yeah, for what it's worth, I mean, we're fortunate, like many of you, to have a lot of relationships specifically in Columbus, and we're not seeing that either with the people that we're talking to, and whether that be in the short north, whether it be in the suburbs, whether it be even in the delineation of the asset classes, we're just not seeing it. So appreciate your perspectives. Let's step away for a minute from the COVID conversation, if you will, and pivot to something that quite honestly I'm intrigued with, and Jason, I think you brought this up, and that is how technology is affecting every role in the multifamily space. So whether it be as a renter, as an owner, as an investment sales professional, very different today, and still an appetite for a lot more of accommodation and making life easier. So I wondered if each one of you might take a moment to just talk about the role that technology is playing in your specific job or daily activity, and if you can, share specific examples and give the audience kind of some real tangible things that they can hook onto in your different roles with technology. Jason, why don't you kick us off?
Sure. No, I appreciate that. It's definitely changed quite a bit. I've been doing this for just under 15 years, and I would say the last 5, it's changed at such a fast rate. It's almost hard to keep up with. But the one thing that I like about Berkadia is that they recognized that early. There's a changing trend. I think probably one of the first ones that we all started using years and years ago when it came out was Zillow, right? It was, let's pull up what's our home worth on Zillow. If you take that and give it steroids and add it to our business, it's completely changed the landscape. So, what our company did is asked Uncle Warren Buffett, who's the majority owner of our company, for a little bit of a checkbook here, and we hired a bunch of data scientists. And what they were doing is they were taking all of the public databases that are available, plus our internal servicing book, and creating apps that we can use. So whether it's pulling expense comps, whether it's pulling up the construction pipeline, whether it's looking at a demographic trend over a certain period of time, or crime in an area, or school system, whatever it may be, packaging that and making it usable to brokerage network that we didn't all go to Harvard. So why that matters is then we're able to provide better insight to out of town owners coming into Columbus. If you're looking to develop inside of Columbus, what areas are we trying to forecast that might be better than others? The goal is not to regurgitate information that's just out there. The goal is to help see around the next corner. And so when COVID happened, it was a good kind of example of the data scientists went to work and said, let's come up with an algorithm. And it's not perfect, but it was insightful to weight the types of job sectors that you have in a market, to weight the wallet share that I was referring to previously, and all of these different kind of components of demographic makeup, and have a resiliency score. Versus, so you take Louisiana or New Orleans, like I was mentioning, versus Columbus. And we started comparing Columbus to other growth markets, Austin, Texas, some of the Carolinas, and it was just off the charts as far as resiliency. And so we can't, publish that and say this is exactly what's going to happen. But if we're taking a project to market today and in still uncertain time, it gives people a better sense of security. And so technology has completely changed what we've done, what we're able to do. And instead of just being a transactional broker, we're providing actionable insights, which I think is what our clients and the audience, and down to the tenant level that I'm sure Brian and Jane will talk about, are looking for today.
Interesting, very interesting. Additional thoughts?
From an operational standpoint, our basic is RealPage, and it is incredible how many software companies are tying in to RealPage as their platform. And there are really, for the active adult space, there are some really great CRM software programs out there that we've just have been coming around in the last year or so. From a resident standpoint, and especially not to go back to the COVID topic, but there are so many great software products that are health, wellness, fitness, concierge services, active building, which is part of RealPage. And we have seminars on a fairly regular basis for our residents to teach them how to use these, whether it's virtually or whether we do them at the Commons as a social event. We haven't done them obviously in a couple months, but our resident is incredibly tech savvy, and they love it. They love all of the options that not only we provide them, but they find on their own. So it's the software and the apps, they're great for our resident.
Perfect. Thank you.
For us, there's a couple different things. One is like marketing online now. People are online more than ever before. I think our website traffic's up 30%, compared to last year. And obviously we want to be able to have our residents or prospects apply online if they don't want to worry about writing a check or anything like that. They can apply and pay rent online, which is big. We've had that in place for a while. Also, you know, our development down in Palm Beach Gardens, we'll get people from New York who will apply like sight unseen. So we'll do virtual tours if they're coming in from the Northeast. And that's been really helpful for them to see the community and see their apartment, and then they can just apply online without even having to see the, you know, actually come to the community. One negative thing is like these Zoom calls and stuff, like especially like if you're doing like a zoning hearing or trying to get plan approval and you're on a computer, I just don't think it's the same as being face to face and meeting with people. So I can't wait till that comes to an end. I understand, you know, why we're doing it. It's important to be, you know, on your own and be safe and everything. But I just think it's really hard to present a huge 300-acre development on a small little computer screen. So I think that's a negative thing.
Yeah, I imagine that would be very difficult to actually, you know, present and manage the screen and do those types of things. Nathan, what are your thoughts?
Yeah, to Brian's point, real estate people, we like to get out and meet people and have coffee and talk to people. So that's been a challenge. But I guess in addition to that, what's been mentioned, really getting down to the property level, I've seen a lot of ownership groups, management groups doing those virtual tours, getting more creative. You know, that technology was out there. It was just something that wasn't as utilized. So, you know, making sure marketing is up to date, you know, at the property level to get the units occupied is, you know, drone footage and really pointing out neighborhood amenities. You know, here's the Starbucks and just kind of highlighting that kind of stuff from drone footage. I've seen a lot of that, and the interior tours, and for us as well, because property tours when we're selling a property is so important. Getting the decision makers on site and seeing it and walking through it and getting their questions out and answered. Yeah, that's something that's restricted us a little bit. So our marketing more geared towards the digital, you know, videos, drone footage, interviewing managers, to have that so you can go in and click on it and we ask the, you know, the typical questions we would see on a property tour about the tour, you know, about the asset, about the opportunity, about the area, the resident base. So we try to get all that stuff out up front. So with the idea of you're having a property tour from your office in New York or from Denver or whatever it is, and just really trying to bring that to experience, you know, as much as we can.
Let me throw out a follow-up question to the group. And I know, Brian, you talked a little bit about how maybe it's a little bit of a negative when you're trying to get a new project off the ground because you're not able to, you know, really in a small window box present, as you said, a 300-acre project. But is whether you're doing a virtual tour, Nathan, for a buyer up in New York, or whether there's a virtual tour for a renter moving from Dublin to New Albany, is it hindering? Is it hindering the ability for individuals to transact, whether it be on the sales side or on the rent side, or is it not?
Yeah, I wouldn't say it's hindering it. It's just an added element of you know, being creative or maybe delaying the process. You know, typically we would, if you're submitting an offer, we want you to tour the asset before you do so. We're pitting a little bit where you know, you underwrite, you do the virtual marketing, and maybe you make an offer when you realize, hey, you know, you're kind of in the best and final group or something where, you know, this is close. Now we're seeing people get on planes and, you know, that
right.
to do it. So I definitely noticed travel being picked back up, which is a good sign, and you know, doing property tours as much as we can, but also just groups understand the importance of getting on site to the asset. You know, this isn't, we're not buying Walgreens. You know, that you're just looking at the lease. And, you know, these are physical assets that need to be walked. You need to understand the asset. So I wouldn't say it's hindered it, but it's, you know, just presented new challenges that we have to get creative and overcome.
You know, our consumer is influenced by their child, by their adult child. And a lot of our residents are coming from outside of Columbus. And so the self-guided tours and the virtual tours and the, you know, online application is becoming a complete norm. We've had numerous residents move in that it it wasn't sight unseen, but they saw it on a self-guided tour. And because their kids lived in the neighborhood, in the area, they were familiar with the area. But had it not been for the self-guided tour, for the virtual tour, I think that's going to become a norm. I think that that's just part of our marketing plan now. And back to the drone footage, we're doing drones probably at least once a month and updating them, because our resident who's coming from out of town really enjoys seeing where they're going to be. So I just think that's just going to be the way it's going to be.
Yeah, I agree. There's been a lot of discussion, even in our space, about adopting some of these practices going forward to expedite the process. So I want to move on, because there's two other questions. We've got about 10 minutes left here. Two other questions I want to get the panel's thoughts on. And so the first one is as everybody is always talking about, whether good times, bad times, headwinds, tailwinds, financing. This event, a lot of people are referring to it as a black swan event in the capital market space, certainly has changed the way lenders, equity providers, folks are coming to the table with dollars, are looking at business today. At the beginning, we went kind of to a standstill, although many would say not exactly the same as what we were in 2008, 2009. I think now the gates have opened back up, not all the way, but much more so than what they were when we started. I'd ask you on the panel too, if you've been in the market, if you know someone that's been in the market for financing, for equity. Let's just go around the horn and give some perspectives, if you would. Brian, you want to start us off?
I think the banks are still really excited about new construction for multifamily. I think they're maybe not loaning out the same amount of dollars that they would have a year or two ago. But, if you can get 75 to 80%, that's pretty good, I'd say, in new construction, and still signing personally on the loans. As far as refinancing, the life companies have seem to be the best for us. We've been working with them, and it really hasn't changed too much during COVID. I think the fact that we're in Columbus, our developments that are here are strong. Like, I think a lot of people are going to be moving out of the larger cities and that are more dense into the Columbus, type markets, and Nashville and places like that. So I think it really helps Central Ohio in the long run. And also too, like, shifting topics a little bit right now, there's a lot of renters by choice. So it's not like 15, 20 years ago where like you had to rent. Now people want to rent, so people can afford, living in our communities, and they want to have all the amenities there. You don't need to be a member of a gym anymore, and there's so many things that they can do right at the community. So for me, for the financing world hasn't changed too much so far.
Yeah, I'd agree. When we first, we're all getting to know this. The lending shut down for 2-3 weeks, and everybody was trying to figure things out. The 10-year was just all over the place. But once we got through that, I was a little nervous about the reserve requirements that were put in place. I thought that was going to have a big impact. But once we started modeling how it looked, it really wasn't that bad. There's an impact. We adjusted our model to take that into consideration, but it's not, nearly as it doesn't have as much of an effect on value as I thought it might. It's just still groups are just, taking a little bit less cash on cash up front in year one. So we've seen really no change, like Brian said, outside of those minor adjustments, maybe some DCR adjustments, but in terms of not being able to get financed, that hasn't been an issue. I think lenders are hedging a little bit against a heavy hospitality portfolio or retail, but multifamily and industrial has been something that's been very attractive. So we've seen, the interest rates are just ridiculous still.
Right.
And that's been a big reason to help values. I had a conversation the other day about high 4 cap in Columbus. So, that's nothing more than the product of the interest rates, because cash on cash is what we look at most over cap rate. And as long as the debt is that cheap, the values are going to remain there.
Right.
Yeah, I absolutely agree with what Nathan said. Pricing has held, once we got through the initial, let's figure this out period, because of that. And every week it seems like you had new lenders, re-entering the market with their new mandate, whether that be, lower loan to value or, just doing more qualification, with sponsors. We're lucky to have, experienced people across all, product type, there in Columbus with Scott Wilkie and Matt Napoleon, where right away, HUD was extremely attractive. And that was the same thing that happened back in 8, 9, and 10, when there was turmoil in a market, depending on, what you're looking for. HUD helped plug the gap early. Fannie and Freddie kind of caught up, and now you've seen, as Brian was saying, the banks be back in, and then you've got, life companies back in. I think CMBS is back, but still probably has a little bit of room to go. But I think the key for what we do, on the investment sales side, is not just to get a project financed. It's to, find the most aggressive lender, or find the most, the best compatible lender for a particular situation. It could be different for a borrower. If you're a long-term borrower, if you're, looking to float something because you're going to, complete a rehab and sell it down the road. So it's really, now that we have, all of the lenders for the most part back in the market, marrying an opportunity with the correct lending source, which for our sake, is ultimately going to drive value, or if it's for a refinance, help, position that project, properly, and you can put it to bed for a number of years, and go focus asset management on something else. So Craig, you're probably the most in tune with it. What have you seen?
No, I think each one of you
We lost them.
Maybe he'll jump back in.
Okay.
it's always great when technology hits you.
Greg, someone gave you a shout and said you're a great panel. You're a great moderator.
Oh, thank you. The short response, Jason, is that we've seen everything that you've seen. Nathan touched on the fact that there was a little bit of glitch in the middle, and the reserves came out, and everybody, kind of paused to say, is this going to be impactful? But I think whether it be the life insurance companies that Brian referenced, or whether it be the agencies, or whether it be the banks, I think for the most part, I would say that everyone is back to normal, if you will. I want to do one thing, because I wanted two things. One, I want to thank each one of you for participating this morning. Your insights and thoughts have been very much appreciated by me, and I'm sure by the audience as a whole. So thank you for participating. We've got a few minutes here, and the last question I would just like to pose to the group is, I'd like to get your thoughts on what the future looks like for multifamily here in Columbus. What do you think the biggest challenges are? What do you think our biggest advantages are? And if we just go around the horn, we'll kind of use this as our sign-off question, Todd. And once again, thank you to each one of you for spending some time with all of us today. Jane, you want to lead us off?
Yeah, to follow up on the last comment and to answer your question, it's interesting. What we're doing is we're creating a brand in the active adult space. And we've had all the same experiences as all of you have in the financing world. What we're doing is getting a lot of interest from both coasts on rolling out the platform with us. And to Nathan's point, there's a lot of family offices that are very interested in getting not in just to the Columbus market, but to the Midwest market. And so that is the direction that we're heading, is to pretty much have 3 to 5 of our projects in all of these Midwest markets. And it is exciting to see how many that they're coming from the coast, that they're seeing how valid and valuable and the growth of the Midwest is. And so it's a really exciting time for us. And there are only more baby boomers coming on every day. So we're excited.
True.
We agree too. Like we have a community that's an active adult development, where it's real low density 4-unit buildings with 2-car garages. And I agree with Jane. I think that's a really hot market right now. So we're going to continue to build that product throughout for empty nesters. Also just think, in the high-end suburbs where we've been building for over 45 years, you can't go wrong if you're in, the Powells and the Dublins and those type of markets in different Midwest cities. And, we think the toughest thing right now is getting into those tough markets and getting the density that you need to make the numbers work, because a lot of the landowners, they want good pricing now because the market's good, and the different townships and municipalities that need to understand that density is not necessarily a bad thing, that you can still build a really high quality product and have density as well. So thanks again for everyone being here, and thanks for doing a great job moderating.
Thank you.
I appreciate that. Jason, Nathan, any closing comments you want to throw in here on what you think
Nathan.
of Columbus?
Yeah, I'll say, in terms of the advantages, I mean, there's so many, and we've talked about it throughout this panel, but just the resilience of the Midwest, but Columbus specifically, when, the exception of Chicago, I think Columbus is the hottest market in the Midwest. Chicago's a little bit different than Midwest markets is what I'm comparing, but overall, I think multifamily is coming out of this stronger, and I believe that from the beginning. You can't pump $5 trillion into the economy and increase the money supply and not expect some form of inflation. So hard assets, real estate, are going to become more and more desirable over the course of not just the short term, but the long term. And furthermore, into real estate, multifamily, I mean, we're all in a business that sells a product that's a basic necessity. It's something we need. People need to live somewhere, and I think there's always going to be not just a need for renters, but also the renters by choice that Brian alluded to is going to continue to remain strong. So I think all of that, and the government restrictions from other markets where new money's coming in, that's just going to continue to benefit markets like what we have here in Columbus. So I think there's just a lot of positives to be excited about moving forward. And in terms of challenges, I think in no city, no market's immune to this, but I think the biggest challenge is just where does unemployment go with this?
Yeah.
There's only so long we can provide these unemployment benefits. It's kind of the necessary evil that's going to, that $5 trillion that I mentioned. We're down to, I think it was 10.2% was the last one that came out for July. I think it's going to get into single digits, but that's just one thing none of us on this panel, nobody listening or anybody I've talked to can confidently say where it's going, especially in the service industry. But if that remains double digits for a while, we may have challenges with people paying rents or occupancy or rent increases over time. But other than that, we're really primed in a great position, and it's exciting to see how things will move forward.
Great, Jason, why don't you take us home?
Sure. No, and again, appreciate everybody's time and everybody on the panel. Columbus is by far the #1 market that our team works. We get asked about it more than any other market, and it's obvious as to why. If you look at the actual fundamentals of a growth market in the Midwest, it checks all the boxes with flying colors. And if you look at over the last 12 months, 3,500, 4,000 units delivered. In the next 12 months, you're talking closer to 6,500 units, but net absorption has been strong. So it doesn't mean in one small pocket, there may be a little bit of concession, but when you look at the long-term, repercussions of what's happening in other cities, I think Columbus is poised to gain population at an even faster rate. Maybe somebody comes in, they're well educated, they go to Ohio State and then they want to go to New York or Chicago or out in the West Coast because that's where some of those prestigious firms are at. I don't think that those firms stop recruiting from Columbus or Ohio State. I think they continue, but instead of moving out there, you work remotely. So maybe it's some sort of a hybrid where it's a young, vibrant city that has seen tremendous growth, and nothing that we can see or point to on our technology side is slowing that down, which is why you've seen the interest that you've seen. So, I guess to not, predict the future, the only thing that I guess I could say would be somehow they figure out how to play college football and Justin Fields win a Heisman. So that's
Very
it.
good.
That's my prediction.
Very good. Very good. Well, thank you again to the panel. Greatly appreciate your insights, your time, your thoughtfulness this morning. Todd, we'll turn it back over to you.
I got to agree wholeheartedly on college football. I don't know what we can do. Maybe Jason, you and I can just grab some pigskin and just go on.
There you go.
Well, I'll put on a Minnesota. You put
There you
on
go.
Ohio State. Let's go. Well, thanks, everybody. So in order to get on to the next panel, you got to go back to the virtual lobby. The timing is a little bit off in the virtual lobby. We are going to start the next panel at 10 o'clock in 4 minutes. So we'll see you there. Enjoy and hope to see you on the other side.
Thanks very much.
Thanks, everyone. Great
Thanks,
panel.
everybody.
Yeah, thank you.